G'day, and welcome to another episode of This is Investing. I'm your host, Vince Scully, and today we're talking about investing in Australian equities. So taking the lessons we've taken out of the last few episodes and applying them to just the Australian market. Traditionally, Australian investors tend to start at home and invest much of their portfolio in Australian shares. In part, this is familiarity, and in more recent years, the available of franking credits. Younger investors, on the other hand, tempted by recent outperformance in the USA, have tended to invest a little bit more overseas. This tendency to overweight your home country is often referred to as home bias, suggesting there's something wrong with it. In today's episodes, we're going to look at investing in Australian shares. That's after this. So firstly, let's deal with this issue of home bias. It's a term that sounds like it's a bad thing. And to an extent, it is. But, if some is good, more isn't always better. So it's about getting the right balance. So what is it? Well, across the world, individual investors tend to overinvest in their home country relative to its share of the world share market, with the possible exception of US investors. And this is called home bias. That is, we are biased to our home market. Ken French of Pharma French five-factor fame noted when he studied this back in 1991 that around the world, investors tend to hold between 80 and 90% of their portfolio in home country stocks. Since he wrote that paper, that's clearly fallen as investing in overseas markets has become cheaper, more convenient and more available. Australian investors are sort of in the middle of this global trend between Japanese and USA investors on the one hand, who invest 4/5 of their money domestically, and countries like the UK, where just 20% of their holdings are in local assets. Interesting to see if that number changes following Brexit, but that's a few years old number. Australians sit in the middle at around a third and falling. Some of our super funds already hold less than this, although, to be fair, that is partly around the inability to deploy the $2.5 trillion our APRA-regulated funds manage. Since the whole Australian share market's worth about $2.5 trillion, that's our problem with just deploying those large sums of money. But home bias goes deeper than that. It's a natural human tendency to gravitate to the familiar. But there are also sound investment reasons why you shouldn't be allowing global market allocations to drive your investment choices. After all, most people in the market are not playing the same game you're playing. So the number one reason is it's cheaper, although that difference is reducing. And now investing in the US particularly can be extraordinarily cheap from a fee perspective. But of course, if you're not paying for it, you are the product. So you need to be careful what you're giving up to get that low-cost trading. But it's got tax advantages, particularly with franking. You don't have a currency risk. You've got, to many extents, lower fees because you don't have to pay for currency conversion. And importantly, it provides a hedge against local inflation, which is what you're going to spend into. We're also a relatively stable market. Australia's the 12th biggest economy in the world. We have a relatively stable government. We have a well-regulated market. And the government has been relatively stable. And even different governments tend to behave broadly the same when it comes to market regulation. The downside is greater concentration. So lack of exposure to the broader global economy and potentially higher volatility of investing locally. Holding assets in a foreign currency, especially US dollars, reduces volatility for an Australian investor. And this is because when global markets fall, investors flock to the US dollar, which pushes the US dollar value up relative to the AUD, and that cushions the fall in the value of the underlying asset. Now, some of this benefit disappears, though, if you hedge your foreign currency exposure. And some of the popular multi-asset ETFs do this. So Vanguard Diversified High Growth Funds hedges part of its global equity exposure back to Australian dollars. As a general rule, you want to hedge your overseas bond exposures because you're going overseas in bonds to get diversification, but you don't want to pick up currency risk. But you don't want to hedge your equity exposure because that's why you're investing globally. Talking about the Australian equity market generally, though, it comes in for a fair bit of criticism as a place to invest, especially among the tech bros on Reddit. It's perceived as low performing, they say. And this is mostly, and we looked at this when we talked about indexes in a previous episode, this is mostly because those commentators are generally looking at the ASX 200 and comparing it to the S&P 500. Now, both of these indexes are price indexes, which means they don't take into account dividends, or indeed buybacks in the case of the S&P 500. The ASX 200 has a typical distribution of about 3.5%, while the S&P 500 has a yield of about just over 1. So that difference in yield gets lost when you're looking at just price indexes. It's also a very biased view that it's true in recent memory where the US and especially the tech-heavy NASDAQ has delivered an outsized return. So if you're under 40 and your memory of investing is in the post-GFC world, the US has certainly outperformed the rest of the world in that period. That started to turn around a bit in the last year, but certainly over the last 14 years, the US has outperformed. That's not true over 25 years, and it's not true over 125 years. And when we're talking about investing biases, recency bias is a much bigger sin than home country bias. So be very careful with drawing the conclusion from recent events that because the US has outperformed recently, it will always do so. And there's clearly very little evidence to support that. There are periods when the opposite has been true, and don't expect it to continue. The other argument that people apply as to why investing in Australia and the ASX 200 in particular is a bad thing is because it's highly concentrated. And this is certainly true and becoming more and more true. The top 10 stocks on the ASX 200 account for about 46% of the total value. That is almost half. The S&P 500 is catching up rapidly, driven by the growth in the Nvidias and Apples and the other trillion-dollar company players. So the S&P 500 is now at just shy of 40% in the top 10. So it's coming close. This was a very valid criticism a few years ago. The other argument that people say was, well, if you're buying Australia, you're buying banks and mines. And That is true. So the ASX 200 is 33% financials. So $1 in every 3 is represented by a bank or an insurance company. And about $1.05 is represented by materials. And just 2.8%, or about $1.40 in information technology. S&P 500, on the other hand, is 35% in information technology and 13% in financials, but just 1.6% in materials. So that is certainly different, and certainly those information technology stocks have delivered outsized performance over the last 5 to 10 years. Very true when we look at the NASDAQ in particular. But this to me is more an argument about diversification rather than an argument to avoid or favour either. That yes, they're different. Yes, they perform differently. Yes, they're invested in different things. But that's a reason to hold both. The question is how much of each and when. So the question then is, well, what's right for you? How much of your portfolio should you be investing in Australia? And so the argument goes that Australia is just 2% of the global stock market. So to get broad diversification, you should invest in those proportions. That is, you put 2% of your money in Australia. That's 2% of your equity allocation into Australia, and the balance overseas. And in most cases, that would be 60 to 70% in the US. But this ignores the fact that most Australians earn and spend in Australia, and they get taxed in Australia. All of which suggests to me that you should have more of your assets in Australian dollars to hedge this currency risk and to hedge your local inflation rate. By more, I mean more than 2%, not necessarily more than the US. And franking credits also make Australian equities attractive from a tax perspective. Although, as I've said many, many times, you should never let the tax tail wag the investment dog. And so tax alone should never be a reason to make or not make an investment. So the US has outperformed in recent times. It didn't over 25 years or 125 years. And these things move in cycles. Diversification is your friend, and you're likely to want to overweight Australia relative to its share of world markets. At Life Sherpa Invest, for example, we typically allocate 40 to 45% of our growth allocation to Australian equities, split between large cap and small cap. And by way of comparison, the Vanguard Diversified High Growth Fund, a very popular multi-asset fund with $3.5 billion under management, sits at just under 40% of its growth allocation. So having said that, we're going to take a break now, and when we come back, we're going to look at how you can apply this in practice to meet your needs with the available products in Australia.
This Is Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
And we're back. And now we turn ourselves to, well, how do we actually invest in Australian equities? So how should I allocate my money to Australian equities, and how should I deploy that cash? And I want to start with the broad-based large cap funds. So that's companies in the ASX 200 or ASX 300. And if you go back to our index episode, the things that we need to look at when we're looking for an index fund is to start with the nature of the underlying index. Secondly, look at the size of the fund. So you want a fund that's got $500 million or so under management, unless there's a particularly strong argument for looking something niche. You want to look for low management fees, where like for like, lower is better. But make sure that you really are comparing like for like. And to some extent, when it comes to large cap equity funds these days, index fund fees are getting vanishingly close to zero. So there's not a lot of practical difference between a 0.04% fee and a 0.07% fee. Obviously, less fees, good fees, but you really want to make sure you're comparing like with like first. And they're getting so small a difference that they're becoming largely academic. The next thing you should look at is liquidity. So that is how much of this fund gets traded every month or every day or every week or every year. And more is generally better. You're really looking for 4% a month or more. So if the fund's got $100 million under management, you want to be seeing monthly volume of $4 million. And that sort of leads us to the next item to look at, because the two are very closely related. The next topic is spread. You may hear this referred to as slippage. It's a bit of a trader thing. I'm not sure it's a term I particularly like, but the spread. So that is the difference between the buy and sell price. And generally, lower is better. For a large cap equity fund, this really should be 0.1% or less, ideally 0.05% or less. The next thing you should look at is, well, what are the returns and the tracking error? So how closely does it follow the index that you're looking to track? For these sort of large liquid funds, you're really looking at tracking error of 0.25% or less. Now, tracking error is considered a bad thing, a small tracking error is considered a good thing when it comes to index funds, but it does come at a price. That it does mean that the manager has to follow the rebalances very, very closely, which means they're going to be buying and selling on the day new companies are added or old companies are deleted. And prices do tend to run up for new additions and run down for deletions. So that comes at a cost. But when it comes to index funds, a low tracking error is generally considered good. And the final thing you need to look at is, well, how long has this thing been around? And what's its history? So you really want to have a fund that's been around for a while and has a steady level of inflows, and that it's remained true to its stated objective. So a fund that changes the index it tracks, Beta Shares, green bond, I'm looking at you, that's a red flag. That's hard to pick it in advance, but a fund that's done this a few times is one that you should certainly be questioning whether that's meeting your need. So ideally, we would look for 5 years or more of history. That's time for a fund to attract a good level of funds under management. It's a sign it's going to, if it survives for 5 years, it's likely to be around for a long time, and its metrics will have settled down. So a small fund growing rapidly will appear to have high turnover, even though it's mostly buying interest, and it's likely to have a higher spread. So you've got to look at these things in context and make sure you're comparing like with like. So when it comes to Australian equities, the Vanguard Australian Share Fund is by far the most popular. It's got $22 billion under management. AFIC, which is a listed investment company, A200, that's a Beta Shares 200, IOZ, the BlackRock ASX 200, and Argo, another LIC, all have around the $7 to $8 billion mark. And STW, the OG ETF in the Australian market, is sitting at about $6 billion. So all of these are market cap weighted large cap funds, apart from AFIC and Argo, which are not indexed. So they're very much benchmark aware, but they're not market cap weighted. So VAS, the Vanguard Fund, tracks the ASX 300, while IOZ and STW track the ASX 200. So there's 100 extra smaller companies in VAS than there is in the other two. Because of the heavy concentration in the big companies, those extra 100 don't account for very much of the fund, so they have a very minor impact on the performance. A200, the Beta Shares fund, tracks a more obscure index. It's produced by a company called Solactive out of Germany. It's very close to the ASX 200, but it's sufficiently different to avoid paying the S&P licensing fees, which start to become material when you're looking at management fees of 0.04. So S&P will be getting a big chunk of that. It's not disclosed, but it will be a substantial, a material share of it. So that ASX 200 has exhibited slightly lower volatility than the ASX 200 and slightly higher returns over the 5 years. These are, basis point differences, but, nonetheless are worthy of consideration. So we prefer at LifeShare Invest VAS because it's big, it's been around for a long time, and there's slightly broader diversification. It also has greater liquidity than of its competitors and the equal lower spread with A200. We don't find Argo or AFIC to be a particularly attractive option, although they do offer lower volatility. We dislike the complexity and the difficulty in making direct comparisons, and the world has really moved on from the LIC structure, and they simply haven't. In more recent times, GlobalX has launched a new A300 fund. That's a 300 largest stocks. But instead of tracking the S&P 300 like VAS does, it tracks the FTSE Russell Australia 300 index, which to my mind is a far better constructive index. It obviously doesn't get the press that the other two do. It probably has lower licensing fees. But to my mind, it's a better constructive index, which should deliver a better outcome over time. And the key difference with this index, which is extraordinarily important, is that the FTSE 300 index excludes secondary listings, so companies that have their primary listing overseas and a secondary listing in Australia. So there are quite a few New Zealand companies that have their primary listing in Wellington, but are also listed on the ASX, and they're counted in the S&P ASX 200, but they're not counted in the FTSE Russell. So these are companies like Fisher & Paykel, Fletcher's, and companies with UK listings or US listings where they trade in Australia as what are known as CDIs, certified CHESS depository instruments, which represent a share held on trust for you. They tend to behave slightly differently to local shares. They're not Australian, although many of the brands might be very familiar to you. And for these reasons, we think that they're less characteristic of the Australian market. They generally don't pay franked dividends, and therefore we don't believe they should form part of your Australian equity allocation. That's not to say that individually any of those companies are good or bad investments. We just feel that they should be included in the category of their primary listing. And so this index will behave differently. If you back test it over the past decade or so, it would have outperformed, and it would have done so with lower volatility. However, this fund is 3 months old as we go to air, and it's only got $9 million under management. So for us, that's too early, too small. And so whilst we have it very much on our watch list, it's not yet ready to be included in portfolios, but definitely something worth watching. And that's a good example of understanding the index that you're buying. One of the big advantages of index funds is that you can go on the issuer's website and download what's called a creation basket, which will tell you precisely what it's invested in. So stock by stock, number of shares, percentage allocation. And when you list out the top 10, they will look remarkably similar. But what you've really got to, the important changes are how different is this, what's known as effectively the active share between one index and another. And these, what might appear fairly arcane and minor differences, can turn out to be remarkably important for your investment outcome. So if we had to choose an index, we'd go FTSE Russell 300 over S&P 500, S&P ASX 300. But the age of the fund and its small size, which means there's a reasonably high risk that they may never get traction. Global X have generally focused on more niche specialist funds, like their gold fund, for example. And so how do they compete against a Vanguard or a BlackRock or a State Street in that highly liquid, highly competitive, low fee space? So can they get traction? The jury's still out on that. I'd certainly love to see this product succeed. I think it's potentially a great product and would be a better tracker for the Australian market than the S&P 300 for my money, but way too early. So that's really looking at the sort of vanilla, broad-based market cap type allocation. And for our money, VAS is the pick. The next place I want to look at is what's called smart beta. Now, smart beta is a bit of a marketing term, and it's designed to play on the fact that when we look at portfolio returns, we look at it in two main components. We look at the beta, which is the market return. So that's often measured by a broad-based index like the S&P ASX 200 or 300. And the value that the manager is adding, which is called alpha. Now, alpha in an index fund should be close to zero. And so the view that there are algorithmic ways of selecting stocks out of the broader index, which should give you a higher return than the market. And we call these smart beta. So Farmer and French back in the 50s and 60s identified a number of factors that should lead to higher returns. So the size factor was one of those. So small companies should, on average, over time, deliver higher returns than bigger companies. Partly because they're bigger risk, partly because it's easier to double the size of a company with $100 million of revenue than one with several $billion of revenue. They also identified the value factor, which companies that trade on a low price to earnings multiple should outperform companies that trade on a high price to earnings multiple. And so on and so forth. So those factors derived algorithmically are often referred to as smart beta. Huge market in the US, been relatively slow to take off in Australia. We've seen a small amount of it, but only one of them has really developed a serious amount of assets under management that makes them serious players. And that's MVW, which is a VanEck fund. It's an equally weighted fund. So rather than choosing your portfolio components in proportion to the total value of the business or market capitalization, this says we're going to select, in this case, 72 stocks out of the 200 or so, and buy an equal amount of each of them. Now, that has a few consequences. Firstly, it means that you're going to overweight smaller companies because you're buying the same proportion of a small company as you are of BHP or CBA. And therefore, you're buying some small premium factor. You're also likely to underweight financials because the financials tend to be bigger. So think CBA, NAB, Westpac, ANZ, Macquarie, QBE. And so you'll have less of them in this portfolio than you will in the market cap weighted option. And you're also likely to be underweight resources. All of which, in theory, should, on a factor basis, lead to a higher return over time. The downside of an equally weighted portfolio is it requires more maintenance and more trading because a market cap weight fund, until you change the constituents, maintains its weighting as the market moves up and down. An equally weighted portfolio, on the hand, will change every day, and you've got to, at some point, rebalance back. And so when we look at the comparison between an ASX 200 fund and MVW, ASX 200 is 33% financial, MVW is just 18%. ASX 200 is 22% materials, MVW is 16.5%. So that delivers diversification and delivers access to the small premium factor. However, in practice, it's actually underperformed the ASX 200 over the past 5 years, some of which is a consequence of the banks and, to a lesser extent, resources dominating those returns. So CBA and Macquarie are one of the some of the few companies that have outperformed the index generally. And it certainly hasn't delivered its promise of lower volatility. It's also much more expensive. It's an order of magnitude more expensive than the others who are in the sub 0.1. MVW clocks in at 0.35%. Not a massive number by historical standards, but for a algorithmically driven fund, it's not particularly cheap. So, love the theory. It's a great concept, but in practice, it hasn't really delivered. And so that's why we don't invest in it at Life Sherpa. But this whole concept of smart beta being accessing things that are likely to deliver higher returns is a great idea. And for that reason, dimensional funds management have got some great products. They're slowly moving these into ETFs. Not a lot of volume to date, but on the managed fund side, many of these funds are a great offering. And we'll talk about that in a future episode. But right now, we don't really see smart beta in an Australian context being a hugely compelling story yet. But watch this space. Moving down to small and micro caps, I would say that most ETFs in Australia get a failing grade here. The indexes they're tracking are a poor way of realising the small cap premium. There's firstly in Australia, the small cap indexes that are investable, so the small ordinaries tracked by, say, VSO, the Vanguard Small, not sure what the O stands for, but the ticker is VSO. That tracks the MSCI, Morgan Stanley Capital Investors Australian Share Small Cap Index, which is largely the lower end of the 200 and 300. And that includes a whole bunch of companies that I would describe as dividend traps, that they have high yields, they look good, but they're not the growth stars that you're looking for. So you're looking for companies with high growth potential, trading at a low price, and with good management and a good market position. Indexes don't do a particularly good job of capturing that data at the small end of the market. And so we don't see index as being a particularly attractive option in this space. So you really need to be looking outside the ASX 300, and that needs specialist management skills. And ideally you want to be combining two or more complementary methodologies here. It's a topic for another day, but active management, diversification between managed with complementary styles really pays off here. And so that's where we would be focusing our small cap options. And there really isn't an ETF option here. There are some smaller LICs, but size makes them a questionable investment. So pulling that all together, start with what you're trying to invest in, and the core of your Australian equity exposure should be Australian large cap equities and a market cap weighted indexed option is likely to be the better option. For us, VAS is that preferred option. We'd really like to see the Global X A300 make it, and because we like the index better, but we don't see that yet as a suitable vehicle for our portfolios. You may be able to take a more gung-ho view of the world, but at $9 million assets under management, we think this is still too small. Global X is a great player. They've been around for a while. They got a lot of resources, but they haven't really played in the more vanilla ETF space. So I think that's a watching brief for us. And when it comes to small cap, I'd be looking at managed funds, active funds, and a huge amount of due diligence. So we meet with the portfolio managers twice a year, and we're constantly in touch. We go through their methodology, we do a lot of due diligence, and we select complementary managers. So all of that is how you should be looking at building your Australian equities portfolio. So that's Australian equities. Next episode, we're going to look at gold, a bit of a hot topic, and that's not why we invest in it, but it's got a great place in your portfolio. So that's what we're going to look at in the next episode. So till then, bye for now. I'm Vince Scully, and this is Investing.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.